why hold at 4%, according to those four people? Who are they? Well, this minority bloc includes Megan Green. She's an external member of the committee, so like a non-exec effectively. She's also the person I agree with most often whenever I hear her speak. Claire Lombardelli, the Deputy Governor, formerly Treasury Advisor apart from anything else. Catherine Mann, a legendary hawk, a tough US hawk. She did cross the floor in early 2025 and voted for a 0.5% rate cut, but of course that rates were at a different level at that point. It's also a very American way to do these 0.5% cuts. Bank of England drastically prefer the very English, calm and measured way and approach to central banking. And then Hugh Pill, the chief economist, and in theory the very best qualified on the committee to have an opinion, a bank insider, highly respected, replaced Andy Haldane, which were extremely difficult shoes to fill back in 2021, but yeah, a heavyweight economist in his own right. And they presented a comfortable, coherent, hard to listen to argument really about maintaining the restrictive stance. Their dissent was rooted not in the denial of headline inflation or disinflation, but a deep concern regarding the composition of that disinflation. And I do very much agree with this assessment. So, the persistence of services inflation, the hawks argued that whilst headline CPI fell to 3.2%, this reduction is largely driven by volatile and external components such as food and energy prices, factors over which the bank has little control. The core battleground for monetary policy is domestic inflation, best proxied by services inflation. At 4.4%, services inflation is more than double the bank's 2% target. Services inflation makes up 53% of CPI, as I referred to many times, over the past 5 years. But the dissenters posited that cutting rates while services inflation remains elevated risks entrenching expectations of higher prices in the wage setting process. They argue that the last mile of disinflation is the hardest, and premature easing could necessitate a painful reversal, aka rate hikes, later in 2026 if wage settlements do not cool rapidly.